when we get these reports from the COMEX and the CME on a daily basis, they list the amount of gold that is in the COMEX vaults. Currently, there's only about 120,000 ounces of registered gold on the entire COMEX, not even 4 metric tons. There's about 325 paper ounces for every 1 physical ounce backing it.
This Cash-Gushing stock is a pure growth play, with management and insiders owning 60% of shares. A close fund with ties to the Disney family has taken out a stake in the small company, along with Excel Telecom, who is a senior company in the telecommunications industry that services major companies, including the government of Israel and the IDF. The communications revolution is happening right now, and this tiny 30-cent stock is positioned to take over a $10 billion market due to Motorola's recent exit when they were acquired by Google. To learn more about this exciting opportunity, where sales have increased by 50% a year for the past 3 years, visit crushthestreet.com/win.
Hello, everyone, and welcome into crushthestreet.com. I'm here with Craig Hemke, aka Turd Ferguson. His website is tfmetalsreport.com. And my guest is a great educator and an excellent speaker. And if you need any inspiration or conviction to own precious metals, this guy is the one to follow. And he puts out regular and timely information regarding precious metals, and ultimately information that will help you survive and thrive through these changing times. Craig, thanks so much for joining me today.
Hey, Ken, it's a pleasure, and thank you for the kind words. I appreciate it.
Craig, as I told you before we hit record here, I'd like to talk to you about the historical leverage of the COMEX, and I couldn't think of a better person to talk to than you. We've seen gold leverage on the COMEX spiking quickly. A couple months ago, we were at 240 paper promises to 1 registered ounce. Then it quickly jumped to 300 to 1, and I think now we're around 325 to 1. And this is where the manipulation is happening. The demand is spiking and the price isn't going anywhere. But what we're seeing is the amount of paper out there being expanded. So I wanted to ask you why these numbers are significant now, and what have we seen historically that makes these numbers worth our attention?
Well, you make the correct point, Ken, and that's what people need to understand when they look at this paper price of gold and how it either does reflect or does not reflect the true value of physical metal, because the paper derivative bullion bank controlled markets like the COMEX are based upon leverage. And as you point out, that leverage of physical gold to paper gold is at historic extremes. And what do we mean by that? You know, on a physical market, or even the stock market, you might have, there's a set amount of shares available for any stock on a daily basis, and an equity is going to go up or down based upon demand for those shares. But that's not how it works on a paper market like the COMEX. A lot of times when there's demand for paper derivatives, where speculators or traders are wanting to go long, these banks that act as de facto market makers just simply create new contracts. They don't supply more physical metal into the market. The last time that scheme was attempted to control price, we called it the London Gold Pool, and that lasted about 7 years before it finally exploded. It just completely blew up.
Right.
What they do instead is they provide paper metal into the market, and they don't need the physical metal behind it to do so. So when you're talking about the leverage in the COMEX, we're not talking about trading leverage, where somebody can sign up, open up an account online, and put in $10,000 and buy themselves a futures contract. Not that kind of leverage. What we're talking about is the leverage where the banks take the physical metal on hand and then multiply it into paper contracts. When we get these reports from the COMEX and the CME on a daily basis, they list the amount of gold that is in the COMEX vaults in 2 separate categories. One, registered, which is gold that's allegedly cleared, documented, assayed, all this kind of stuff, marked for sale, marked for delivery, if you will. And there's also what we call eligible, which could become registered, mainly through some journal entries, but it's primarily just gold stored on hand for banks or for their customers. It's that registered gold, the stuff that is allegedly, again, marked for sale, able to be used for delivery. That's what we're talking about here. Currently, there's only about 120,000 ounces of registered gold on the entire COMEX, not even 4 metric tons. Now, you got to have some historical perspective to understand what that means. Typically, in the past, that number's been around 1 million ounces, maybe 900,000 ounces. Earlier this year, it was 900,000 ounces. In the spring of this year, it started to fall to 700,000 ounces. In the summer, it fell to 500,000 ounces. A couple of months ago, it fell under 200,000 ounces, and now we're at an all-time low, about 120,000 ounces. But yet, the total open interest, the amount of paper contracts based upon that declining amount of physical metal, has stayed the same. And so that's where we get that ratio that you mentioned. It's now, there's about 325 paper ounces for every 1 physical ounce backing it. In the past, that number was always around maybe 10 to 1 or 20 to 1. It spiked in 2014 up to about 100 to 1 and then fell back. And like you said, now it's about 325 to 1. Yeah, so it's another one of these data points that we follow that seems to indicate kind of a global physical tightness. It does not indicate that the COMEX is going to fail tomorrow. And these banks could always issue a report this afternoon, journaling a couple 100,000 ounces of gold from eligible to registered and drop that ratio back to 100 to 1. But they haven't yet, and it's been like this for maybe about 90 days. So it's something that, again, has caught our attention.
Craig, I wanted to also ask you, well, what is the significance of the COMEX versus some of the other commodity exchanges around the world when it comes to manipulation? We seem to be very focused on the COMEX. Is this simply because this is where the largest amount of fraud is taking place?
Yeah, and it really is the dominant pricing mechanism for the world. I mean, and it's really only open 5 hours a day, though we have almost 24-hour global trading on what we call the Globex, electronic trading. But really, everything does key off the COMEX price. That London has their AM and PM fixes, but really, those are adjusted up and down based on COMEX trading and overnight electronic trading. So it's really all done based off of the COMEX. That is the center of the paper pricing universe, and it has been since January 1, 1975, when COMEX first started trading paper futures. It will continue to be that way until it breaks. What will be interesting, and again, I don't know how far this ratio can be stretched, but again, it'll be interesting to see what the actual physical price is discovered to be once people actually begin demanding their physical metal. Think of it, Ken, as a game of musical chairs. And again, I mean, it could change overnight. We could get this ratio by just a simple journal entry, I suppose, to be cut in half or, 2/3 by tomorrow. But at present, as we speak, think of it as, like I said, a big game of musical chairs where there's one chair representing an ounce of gold, and there's 325 people walking around that chair, and they're going to try to sit on it and pick up that ounce of gold should the music ever stop.
Right.
And if the other 324 people that think they own gold all of a sudden realize, well, wait a second, I thought I owned gold. If all of a sudden they want to get their fill, and they realize that the world is just this scheme, this gold pricing scheme, with over hypothecation and over leverage, and the prices, when the world figures that out and and the music stops, so to speak, price isn't going to be $1,075. That's all I know, and until that day comes, I'm content just to continue to add to my stack, recognizing that, I think there's probably pretty good value here.
I totally agree with you. One day there will be a mad scramble for the exits, and hopefully, we already know that door isn't going to be big enough for everybody.
Right. And Ken, and don't think, and I don't want anybody to think that 325 to 1 is the limit. I mean, it could go to 1,000 to 1. It could go 5,000 to 1. As long as confidence remains that somehow physical metal can be delivered at this paper price, then this scheme continues and people continue to hold their paper. It's when finally we get some delivery failures, not even necessarily from the COMEX, some delivery failures in London, some excessive demand either in the West or more from the East. So something finally is like that last straw, that proverbial straw in the camel's back that finally just that breaks it, that pulls the one card out from the entire house and the whole thing crashes down. It's when that happens, and it, again, doesn't have to happen tomorrow, doesn't have to happen at 325 to 1 leverage, but it's going to happen at some point in the days and weeks and years to come. We just have to wait for it.
Craig, I'd like to get your thoughts on this. Many people today would argue that gold doesn't have a real economic purpose other than to primarily be stored. Prior to 1971, gold had a direct tie to the monetary system, and the government actually pegged the dollar to gold, and this system was supposedly to keep the spending under control. And here's my question regarding central banks, regarding gold. Was gold more of a threat to central banks back when there actually was a gold standard, as opposed to today where it's not directly tied to money, but it's just the world historically deems it as money?
Yeah, I think you're right, Ken. Today, the threat that gold presents to the central banks gets back to confidence. That's the reason why it continues to be managed by the central banks through their agents, these bullion banks that trade and make the markets for the paper metal. And what I mean by that is it's really in two measures. A rising gold price reflects a lack of confidence, not only in the dollar, but in the other fiat currencies. And so that's the first thing. If gold was soaring, if gold had soared after the initiation of QE3 back in 2012, when all of a sudden that long-standing relationship between the total debt of the U.S. and the Federal Reserve balance sheet and the price of gold all of a sudden broke. You've probably seen those charts. Mm-hmm. If gold was soaring then, it would have been a clear lack of confidence, a vote of no confidence, if you will, in central bank policies and in fiat currency in general. Mm. The other leg of that stool is that gold has often been thought of, and I don't know if this is necessarily the right way to look at it, but it's often thought of as a hedge against inflation, right?
Right.
And people say, well, look, there must not be any inflation. Gold's not going through the roof. Well, if gold were going through the roof, chugging through $2,000 an ounce, $3,000 an ounce paper trading, what would that tell you about future inflation or even current inflation expectations? People would say, well, God, clearly there's a lot of inflation. Well, if there was inflation expectations like that, there would be no buyers for government debt at 2% for 10 years or 3% for 30 years, because you'd be looking at significant a big difference between the real rate of inflation and what these bonds were pricing. Mm. And so bonds would have to be, if inflation were actually indicated to be high, no one would be buying bonds at 2 and 3%. But bonds have to be priced that low because of the interest on the accumulated debt. I mean, Ken, think about it. The U.S. has accumulated, what is it now, almost $19 trillion in national debt. And the only way that the budget line item of interest on the national debt has been able to be maintained low, below $400 billion a year, is because the Treasury has moved almost all that debt into less than 5-year maturities with an average yield of just 2 or 3%. Wow. If all of a sudden rates were to reflect inflation, and gold would be, a high gold price would make you think that. That's just one of the things that would make you think that. But if rates were suddenly 5%, 8%, well, then that interest on the national debt, instead of being $400 billion, would be north of $1 trillion.
Right.
And these numbers that the Treasury Department and President Obama like to tout about, oh, look at our budget is under control. It's only $450 billion deficit a year. It'd be $1.3 trillion a year. You see what I mean? The whole thing would spiral that much faster.
Yeah.
And so the price of gold isn't necessarily a threat in terms of what it was when we still had a gold standard and a gold window in the U.S., but it's a threat in terms of confidence and maintaining this Ponzi debt scheme. So anyway, that may be a little longer answer.
No, that's fine. I was really curious to get your thoughts on that, because a lot of people, they see gold as a potential sideshow now, because if it is just something that is stored and it isn't directly tied to money like it was, it might be a jump to say that gold is money. It's money if people deem it as money, right?
Well, Ken, it's been money for 6,000 years.
Yeah, and I agree with that.
And people lose perspective. I'm not saying you do or any maybe even anybody listening to us, but I think the vast majority of people can't see a whole lot farther than arm's length, and they really only understand things that have occurred in their lifetimes. Okay, and so really, 99% of the population, and certainly anybody listening to us, the only economic condition, the only financial paradigm that they've ever known is the U.S. dollar as a reserve currency, which came into effect after World War II and has been, that Bretton Woods system and the U.S. dollar as the world reserve currency has been that way now for 70 years. So, I mean, you'd have to be like 100 years old and listening to us to remember a time when the dollar wasn't the reserve currency, when there wasn't some type of fixed hard asset like gold standard. Okay. That's the norm, not just what's the last 60 years has been. But everybody, I think it's just kind of part of the human condition to have this normalcy bias and think, well, tomorrow is always going to be just like yesterday. And it's not. And I think it's pretty clear that ever since after the financial crisis of 2008, the dollar creditors of the world, be it India or China, these BRICS nations like Russia, they decided that there is going to have to be a new global financial system sometime in the 21st century, maybe not next month, but sometime maybe in the next decade or whatever. And that system will likely be based again, as these systems always have been, on some hard asset backing. And so gold isn't going away as money. It's not going away as a permanent, loss toward backing a monetary system. I'm pretty certain it'll come back. History will repeat itself. It's just not the way it is at present.
Craig, you already alluded to the London gold pool and it lasting 7 years, and not too long afterwards, we got the COMEX, the COMEX has been around now for roughly 40 years. Would you agree that the COMEX was the replacement of what was the London gold pool?
Yes, absolutely. That is astute way to pick up on that, Ken. That's absolutely correct. And what perhaps we should just take a second and let people understand the history, because after Bretton Woods, the dollar was convertible to gold. It was as good as gold. You've heard that phrase. But what the problem was, in rebuilding the world, we shipped dollars, all over the place. A company, either through direct aid or countries rebuilt, and we bought their goods and all this stuff. And so countries like in Europe, France, and others developed this massive dollar stockpile, which then they wanted to convert to gold, right? Because they could.
Right.
And in 1957 and 58, there was a huge scandal in the U.S. because the U.S.'s gold reserves that we accumulated after World War II were cut by about a third. Almost, I guess it would be between a quarter and a third. In 57 and 58, there was kind of a little bank gold run, if you will, of these countries converting their dollars into gold. There were congressional hearings. I mean, this was a big deal. That was an instance of the U.S. attempting to be their own gold pool, supply physical gold into the market to keep the peg at 35. Well, that wasn't going to fly. We couldn't keep doing that, or we were going to lose all of our gold in the decades ahead. And so beginning in 1961, a consortium was put together of the U.S. and 7 other European countries, where U.S. pledged about half the gold. The other 7 countries pledged the other half of the physical gold. And this London gold pool set out on a mission where every time there was demand for physical gold, the gold pool would supply physical gold to the market, kind of sopping up that demand. Once the demand went away and the price then invariably came back down, the gold pool would go back in and buy gold back. And again, attempting to keep that $35 an ounce standard. So now the U.S. and 7 other countries are on the line. That worked. That held things together for 7 years. But in 1968, the demand for physical gold had grown so much that the gold pool collapsed. There were not enough. Nobody wanted to pledge gold to peg that price. And so That was the end of that scheme in 1968. Well, then the U.S. and the other countries got smart. And they said, well, look, we're not going to go on our own. We can't supply physical gold to the market because there's just not enough of it to go around based upon the obligations that are out there. And so, we haven't figured out how to do actual, wizardry and alchemy yet, but we can kind of come up with our own little synthetic alchemy by creating gold futures instead. And we can base the price off of this unlimited leverage of the futures market instead, and we'll convince everybody out there that this is the price. And that's exactly how it's worked since January 1, 1975. And again, getting back to where we started this conversation, it is the stresses now in that over-leveraged system that are really beginning to appear. It's not just in the registered COMEX vault. The total COMEX vault is down from, it used to be 10 million ounces down to 8 million ounces. Now it's about a little over 6. We see the stress. We get all these anecdotal stories about empty vaults in London and the LBMA living off of flow. We get the import-export data out of the U.S. and out of the U.K. with consistently showing gold flowing out of the U.S. and U.K., going through Switzerland and then getting exported out of Switzerland, and all of it then being imported through China and Shanghai. All these different stories about really physical gold stress. There's a lot of anecdotal data points out there. Again, they don't necessarily point to a collapse next week. The whole house of cards isn't going to fall in on December 27th of this year. But at some point, confidence in that system will finally evaporate, and people will look around and go, wait a second, I thought I owned gold. You're telling me I just have this paper certificate? That's not gold. I want gold. And when that day comes, again, that's when it's going to get interesting.
Well, you've already alluded to it, but in conclusion, Craig, what are your thoughts on people owning precious metals at the moment and being prepared? And in that, you can also just give people a little idea of what they will find if they visit your website. Well,
Ken, I have no idea if the next, if we won't, maybe we'll see lower lows. Maybe they can just continue to create more paper leverage and drive price down even lower. But we're tracking a number of things at TF Metals report, not the least of which is the actual bank positioning. These banks that make the derivatives, make the market for the derivatives. We're actually seeing signs there of them moving to net long in gold futures for the first time in 14 or 15 years. Some folks have emailed me saying the last time they saw this was in 2001, and I think most people know what happened beginning in about 2002. We went from $250 to $1,900 by 2011. So we only really see this at historic lows, and we're seeing those signs again right now as we speak. So I think the next short-term trend in the gold price is up. When we'll just have to see if the price then is capped again by these banks and then driven back down in 2016. It's really hard to say. We'll just have to see how it goes. But in the meantime, whether folks are trying to trade in that casino or if they're just simply just trying to protect their savings and their net worth, the best option is still to be slowly and steadily accumulating physical gold and silver too on a monthly basis. Just knowing your history, knowing the facts, knowing that the paper price is based off this leverage scheme that eventually will collapse. You just continue to add to your stack, protect yourself financially. You remain situationally aware of what's going on in the world and try to be responsible in your financial planning for yourself and your family. Gold is a big part of that, and it's something that regardless of the paper price, regardless of how the paper price has acted for the last couple of years, people need to keep an eye on the long-term picture and just keep preparing for what is most certainly coming.
Craig, I can't agree with you more, and I just want to thank you for coming on the show with me today and just sharing your wisdom with us. I mean, what a amazing research that you have, and the way you're able to take us through the history of the COMEX and why we are at unprecedented times. It's really amazing, and it's inspiring too to get out there and be prepared. So thanks so much for coming on the show with me today.
Ken, it's my pleasure. Best of luck the rest of this year, and in 2016, it's going to be an interesting time.